All right, this is Ubaid on behalf of Electronics, and in this video, we'll be talking about access reserves and the impact of monetary policies. All right, now when it comes to monetary policies, okay, let's type this in over here. So this is monetary policies. Okay, the impact of monetary policies may not be as much as you expect. Okay, especially when it comes to an expansionary monetary policy. Okay, so the impact of an expansionary monetary policy. This is expansionary monetary policy. Okay, may not be significant. Now there is an analogy relevant to this scenario where when you pull a string using a contractionary monetary policy, it will have a significant effect. Okay, because interest rates go up. Okay, the real GDP is reduced. Okay, unemployment goes up, so on and so forth. And banks, the commercial banks can do little about it. Okay, because they do have to comply with laws and legal regulations. Okay, as a result of which, when you pull a string, when the central bank pulls a string, okay, using a contractionary monetary policy, the effects are as expected. Okay, but when they push the string using an expansionary monetary policy, especially for a short period of time, okay, the impact may not be as expected. So this is significant. All right. So the reason why the impact may not be significant is because the banks may decide to keep the access reserves. Okay. So commercial banks may decide to keep the access reserves to avoid bankruptcy. Okay. So say, for example, you have an expansionary monetary policy. So let's say this is your aggregate supply curve. Okay, and you have your aggregate demand curve over here. All right, now the supply of loanable funds, okay, let's say the aggregate supply of loanable funds goes up, and the central bank is able to buy bonds and bills, treasury bonds and bills from the commercial banks within the nation, as a result of which, okay, the interest rates are reduced and the commercial banks are able to, okay, loan out those funds. Okay, lend those funds to, let's say, individuals and businesses. Okay, however, during a recession, okay, what's going to end up happening is just like consumers forecast the prices going up, as a result of which the demand may go up today and the demand in the future may go down. During a recession, the banks may forecast, okay, the recession up ahead, as a result of which they might reduce, okay, they might stop lending money altogether. Okay, the reason why they might stop lending money altogether is because they do not want to go bankrupt. Okay, they do not want to be in a situation where they might be facing a bank run. Okay, where customers start withdrawing money from their bank account because the customers may think that the bank may not be able to um, keep their assets. The bank may not be able to provide them with the funds they require when they require them. Okay, when they need them. Okay, and because of the economic shrinkage, because of the recession, it's possible that the bank may become insolvent, especially if their assets are less than liabilities. All right, as a result of which, the banks may go ahead and keep the access reserves just in case. Okay, the clients who already borrowed funds from the bank in the form of line of credit, say for example, personal loans, auto loans, so on and so forth, and mortgage loan. Okay, likely, just in case they're not able to return the money, they're not able to pay their interest expense, they're not able to pay the interest on top of that principal. Okay, the banks have some form of securities. They have your insurance policy, they have a backup. Okay, so the banks will go ahead and keep the access reserves. The banks will go ahead and keep the access reserves to make sure they have enough funds in the bank to prevent some kind of insolvency or bankruptcy in the future. They have enough funds for their clients to withdraw. All right, so access funds, okay, to prevent bankruptcy. And in doing so, it has little impact on the central bank's intention to expand the economy. Because if the central bank is lending money, is basically lending money by buying bonds, okay, when the central bank expands the economy or tries to expand the economy by buying bonds and pushing money into the reserves of the commercial banks, they expect the commercial banks to lend money. But if the commercial banks do not lend that money and keep those access funds, the access reserves, to themselves, then obviously it's going to have a little impact on the economic expansion. All right, so access funds, okay, so access funds, okay, are kept in access reserves, as a result of which you have little impact. And this is usually for a period of time, okay, as the country struggles to get out of recession. Over a long period of time, it's possible that the banks may start lending out the reserves, okay, to make sure that they're able to um, get the country out of the economic recession. Okay, so little impact on your expansionary policy, expansionary monetary policy over a short period of time. Okay, and as things start to look good again, as banks prospect um, a bright economic future, obviously they do need the money from the interest, as a result of which they will start lending out money. Okay, so short period of time. All right, so that would be it when it comes to this concept over here, when it comes to access funds and monetary policies. On behalf of B Electronics, this is Obey. Have yourself a great day.